There's a number flashing on financial screens right now that has only appeared 3 times in the last 100 years. Each time it showed up, the world changed forever. Banks collapsed, currencies died, empires fell apart, and it just triggered again. Most people have no idea what this number means. They're too busy watching stock prices bounce up and down. But the smartest investors in history, they watch this one number like a hawk, because when it hits a certain level, disaster always follows. I'm talking about the gold-silver ratio, and right now, it's sitting at 85:1. So what, you might think? That's just some boring metal price thing. But here's what they don't tell you. The last time this ratio stayed this high, it was 1931. Banks were failing. People were standing in bread lines. The Great Depression was ripping the world apart. Before that, it predicted the fall of Rome. Yes, the actual Roman Empire. And the craziest part? This ratio is based on a natural law that's been buried in the earth for millions of years. A law that governments keep trying to break. And every single time they break it, everything falls apart. In the next few minutes, you're going to discover 3 things that will change how you see money forever. First, the ancient rule that empires keep forgetting. Second, why China and Russia are quietly buying up all the silver they can find. And third, the physical shortage that's about to send prices through the roof. Let me show you exactly what's happening right now. Before we dive into why this matters today, you need to understand something simple, something so basic that even a kid could get it. When you dig into the ground, there's about 19 ounces of silver for every 1 ounce of gold. That's just how the earth is made. It's been that way for millions of years. It's not changing. So for thousands of years, the price followed that natural rule. Silver and gold traded somewhere between 12:1 and 16:1. That made sense, right? If there's more silver in the ground, it should cost less than gold. Every major civilization figured this out. The Greeks knew it. The Romans knew it. European kings knew it. They all kept their money systems around that 16:1 ratio. And guess what? Their economies worked. But here's where things get interesting. Empires don't usually announce when they're dying. They hide it. And the best place to hide it? In the money. Think about it this way. Imagine you're running a lemonade stand. You promise your customers that each cup contains real lemons, but you start running out of lemons and you still want to sell drinks. So you start watering it down. First, it's 90% lemon juice, then 80%, then 50%. Pretty soon, you're selling yellow water and hoping nobody notices. That's exactly what dying empires do with their money. Rome did it. They started with coins that were 95% pure silver, beautiful, heavy coins. But they needed money for wars, money for bread and circuses to keep people happy, money they didn't have. So they watered down the coins. By the end, Roman silver coins were basically copper with a thin wash of silver on top. Only 5% real silver. The ratio between real value and fake value completely destroyed. And what happened? The first massive hyperinflation in Western history. Prices went insane. Trade stopped working. The empire collapsed. But that was ancient times, you're thinking. We're smarter now. Are we? Let me tell you what happened in 1873. They called it the Crime of 73. And it was the first time the modern world deliberately broke this ratio. With one law, the US government kicked silver out of the money system. They forced everyone onto gold only. Why? Because rich bankers held gold. Regular farmers and workers held silver. By destroying silver's value, they made gold worth more. Debts became impossible to pay. Farms got taken away. The Long Depression lasted over 20 years. Same trick, different century. Now here's where things get really interesting. Fast forward to 1931. The world is falling apart. The Great Depression is crushing everyone. And sitting quietly in the background, screaming a warning that nobody's listening to, the gold-silver ratio. It hit 97:1. Let me explain what that number actually means because it's crazy. It means you needed to trade 97 ounces of silver, a massive pile of metal, to get one tiny coin of gold. Think about that. Silver is a real physical metal. You can hold it. It has weight. But suddenly it took almost 100 ounces to equal 1 ounce of gold? That's not normal market movement. That's panic. Here's what was really happening. Factories were shutting down everywhere. Nobody needed silver for industry because nothing was being built. But people were terrified about money, so everyone was trying to get gold, the ultimate safe haven. Gold stayed strong. Silver crashed. The gap between them exploded. And that massive gap was telling anyone who was paying attention, the system is broken. Banks are dying. Prepare for disaster. Britain understood this signal. In 1931, they looked at their vaults, looked at the ratio, and realized they were screwed. They didn't have enough gold to back up their promises. So they did something shocking. They abandoned the gold standard completely. The pound sterling, the currency that ran half the world, it collapsed. America watched this happen and panicked. In 1933, President Roosevelt looked at that 97:1 ratio and knew the game was over. The government couldn't keep its promises. There wasn't enough gold in the vaults, so he did something that sounds insane today. He made it illegal to own gold. Executive Order 6102. If you had gold, the government took it. If you refused, you could go to prison for 10 years. They literally seized gold from American citizens at gunpoint. But here's the part they don't teach in school. To fix the broken economy, they had to force the ratio back down. So in 1934, they passed the Silver Purchase Act. The government started printing money to buy silver, desperately trying to bring that 97-to-1 ratio back to normal. Why? Because that high ratio meant deflation. It meant the economy was dying. They had to manipulate the market just to stop total collapse. The ratio predicted everything. The bank failures, the seizure of gold, the desperate money printing. It all played out exactly as the ratio warned. Okay, you're thinking, but that was the Great Depression, once-in-a-lifetime event. Except it happened again. In 1991, the ratio spiked to 100-to-1. Everyone's celebrating the end of the Cold War. Peace is breaking out. Everything seems fine, but the ratio is screaming. And what happens? Over 1,000 banks fail in the savings and loan crisis. Billions in savings wiped out. The ratio saw it coming before the news did. Then 2008. You remember the financial crisis, Lehman Brothers collapsing, banks getting bailed out, the whole system nearly dying. But if you were watching the ratio, you knew it was coming. It jumped from 51-to-1 all the way to 84-to-1 in just a few months. The ratio spiked right before everything fell apart. Why does this keep happening? It's simple physics. When the financial system breaks, industry stops. Nobody's buying silver for electronics or solar panels because factories are shutting down. But fear explodes. Everyone wants gold for safety. That gap between gold and silver, that's the gap between fear and reality. And when that gap gets big enough, something always breaks. But if you think that's crazy, wait until you hear this. March 2020. The world locks down, the economy stops, and the gold-silver ratio does something it had never done in 5,000 years of human history. It hits 125-to-1. Let me say that again. 125 ounces of silver for 1 ounce of gold, the highest ratio in recorded history. This wasn't just a spike. This was the financial system having a heart attack. Think about what that number means. Silver is essential. You need it for medicine. You need it for electronics. You need it for energy. But the market was saying silver was basically worthless compared to gold. Why? Total panic. People were selling everything that wasn't nailed down just to get cash. They needed dollars to pay debts. The bond market froze. Even the treasury market, the safest market in the world, started stuttering. The machine was breaking. So what did they do? They printed money. But not a little money. They printed a tsunami of money. In 18 months, the Federal Reserve created 40% of all dollars that ever existed. Read that again. 40% of every dollar in history was printed in a year and a half. They had to. Because if they didn't, that 125-to-1 ratio was telling them something terrifying: complete deflation. A depression that would make the 1930s look like a minor problem. So they chose inflation instead. They flooded the system with cash. They forced that ratio back down. But here's what they don't tell you. They didn't fix anything. They just kicked the can down the road. Every dollar they printed made your money worth less. The food you buy, the gas you pump, everything got more expensive. They solved a liquidity crisis by creating an inflation crisis, and we're still paying for it today. But here's where the story gets really interesting. Because while all this was happening, something else was going on in the background, something most people completely missed. While Western investors were panicking and selling silver, somebody else was buying it all up. China, India, Russia, the East. They looked at that 125-to-1 ratio and didn't see panic. They saw a clearance sale. They saw the West selling real assets for fake paper money. And they started backing up the trucks. Let me show you why this matters. China doesn't mess around with paper contracts. They buy physical metal. Actual bars of silver, tons of it. Why? Because China dominates solar panels, and you can't make a solar panel without silver. It's physically impossible. The green energy revolution everyone talks about, it runs on silver. Electric cars, silver. AI data centers, silver. 5G networks, silver. China knows this. So while the West is suppressing the price with paper trading, China is buying up the real thing at bargain prices. We're literally subsidizing our biggest rival by keeping silver cheap. India is even more interesting. In Indian culture, buying silver isn't speculation, it's tradition. When silver gets cheap relative to gold, Indian imports explode. Some months, India alone imports a huge chunk of the entire global mine supply. They're trading their paper rupees for the one asset that has survived every empire collapse in history. Meanwhile, Russia is doing the same thing. They're moving away from dollars. They're stacking gold and silver. They're building a parallel financial system. The BRICS nations, Brazil, Russia, India, China, South Africa, are all preparing for a world where the dollar isn't king anymore, and they're using this high ratio to accumulate the real money while it's on sale. Here's the scary part. This is the biggest wealth transfer in history, and it's happening right now. While Americans watch stock tickers and argue about politics, real assets are flowing from west to east. The West is holding paper promises, the East is holding physical metal, and when the music stops, who do you think wins? But the most shocking part isn't what governments are doing, it's what physics is about to force to happen. This brings us to the most shocking discovery of all. Everything I've told you so far has been about money and markets and history, but now we need to talk about something that can't be manipulated or changed or voted away: the laws of physics. See, you can print dollars, you can change laws, you can manipulate markets, but you can't create silver out of thin air, you can't legislate chemistry, and that's about to become a massive problem. Here's what's happening right now, and almost nobody is talking about it. Silver is the most conductive metal on Earth. Nothing conducts electricity better. Not copper, not gold, nothing. That means for certain technologies, silver isn't optional, it's required. Solar panels? They need silver for the conductors. Can't make them without it. Electric vehicles? Each one uses about 1 to 2 ounces of silver in the electrical systems. AI data centers? Packed with silver. 5G infrastructure? Silver. Military equipment? Tomahawk missiles, radar systems, fighter jets, all loaded with silver. Medical equipment? Silver. Every smartphone? Silver. The entire technology revolution depends on silver. And here's the problem. We're running out. Not running out like it's extinct, but running out where we can easily get it. The best silver mines have already been found and mined. The ore grades are getting lower, meaning you have to dig up more rock to get less silver. Opening a new mine takes 10 years. 10 years. From discovery to first production. But demand? Demand is exploding now. Last year, there was a structural deficit. The world used more silver than was mined. This year, bigger deficit. Next year, even bigger. We're draining the above-ground stockpiles. The reserves are getting smaller. But nobody's really panicking yet because the paper price on the commodity exchanges says silver is cheap and plentiful. That price signal is lying. Let me explain how this scam works. In New York and London, there are commodity exchanges. That's where the price of silver gets discovered. But here's the trick. Most of the silver traded there doesn't exist. It's paper silver, contracts that promise to deliver silver but almost never do. For every real ounce of silver in the vaults, there might be hundreds of paper claims on that same ounce. It's like the whole world bought tickets to a concert, but the venue only has 1% of the actual seats. As long as most people don't show up to claim their medal, the game keeps going. By flooding this paper market, they can keep the price low, they can make that gold-silver ratio stay high, and this benefits the dollar. Here's why. If silver and gold prices exploded to show the real amount of money printing that's happened, it would expose the dollar as a fraud, so they suppress the price to maintain the illusion that the dollar is stable. But physics doesn't care about paper games. Right now, as we speak, big industrial companies are starting to realize they have a problem. Apple needs silver for iPhones, Samsung needs it for electronics, Tesla needs it for cars, solar companies need it for panels, and they're discovering that when they go to buy physical silver, not paper contracts, but real metal you can touch, it's getting harder to find. The vaults are running low, refiners are backed up, delivery times are stretching out. What happens when a company like Tesla realizes they might have to shut down a factory because they can't get enough silver? What happens when they stop caring about the paper price and just need the metal at any price? That's when the paper price and the physical price divorce completely. Imagine a spring coiled tight. You're pushing it down, down, down. The more you compress it, the more energy builds up. Eventually, you can't hold it anymore. And when it releases, it explodes. That's where we are with silver right now. The paper market says it's cheap, but physical reality says it's about to become extremely scarce. The industrial demand is surging while the mining supply is flat or falling. It's the perfect setup for a price explosion. And remember, we're doing all this while the gold-silver ratio sits at 85 to 1, way above the natural ratio of 16 to 1, way above the historical average. The spring is coiled, the industrial shortage is building, the East is buying, the West is selling paper. Something has to give, and when it does, this ratio is going to snap back so fast it'll make your head spin. So what does all this mean for us today? Let me make this crystal clear. We're not talking about some abstract financial theory that might matter someday. We're talking about something happening right now that's going to affect your life, whether you pay attention or not. First, let's talk about what happens when this ratio corrects. The natural ratio is about 16 to 1. Right now, we're at 85 to 1. If the ratio just goes back to normal and gold stays where it is, silver would need to go up over 400%. But here's the thing. Gold isn't staying where it is. Gold is breaking records. It's smashing through all-time highs. Why? Because smart money is fleeing the dollar. Central banks are buying gold at the fastest pace in decades. Countries are diversifying away from dollars. The trend is clear, so if gold keeps rising and silver catches up, we're not talking about silver doubling. We're talking about silver going up 5 times, 10 times, maybe more. But that sounds crazy, you're thinking. Silver going up 10 times? It's happened before. In 1979 to 1980, silver went from $6 to $50 in less than a year. That's more than 8 times. And that was with a ratio that wasn't nearly as stretched as today. When this spring releases, the move is going to be violent and fast. But let's talk about what this means for regular people. Because this isn't just about traders making money. This affects everyone. If you're holding only dollars, you're holding the wrong thing. Every dollar they printed to fix that 2020 crisis made your money worth less. The inflation you're seeing at the grocery store, that's the bill coming due. The government will keep printing. They have no choice. The debt is too big. The promises are too expensive. They can't raise taxes enough. They can't cut spending enough. So they'll print. That means your dollars will buy less next year than today, less the year after. It's a slow drain on your wealth. But here's what most people don't understand. This isn't just about prices going up. It's about a currency system dying and being replaced. Look at history. When the gold-silver ratio spikes above 80, major changes always follow. In the 1930s, they seized gold and changed the entire monetary system. In 2008, they printed trillions and never stopped. Each time the ratio spikes, the response gets bigger, the money printing gets crazier, the system gets more unstable. We're at that point again. But this time, the debt is higher than ever, the printing is faster than ever, the system is more fragile than ever. The ratio is telling you that something big is coming. A reset, a restructuring, a change in the rules. And here's what the East understands that the West doesn't. When the reset happens, you want to be holding real things, not paper things. China's not buying silver because they're dumb. They're buying it because they know it's essential for the future economy. Solar power, electric vehicles, technology, all of it needs silver. They're trading paper dollars for physical silver. When the dollar loses its status as reserve currency, those dollars will be worth a lot less. But that silver will still be needed to build things. India's doing the same thing. Generations of Indians have learned that gold and silver survive currency collapses. They've seen it happen. They know paper money comes and goes, but precious metals remain. Even regular people in these countries get it. They're not trusting their governments or their banks. They're converting their savings into physical metal they can hold. Meanwhile, in America, most people have their wealth in stocks, bonds, and retirement accounts. All paper, all dependent on the system staying stable. But the ratio is screaming that the system isn't stable. It's breaking. Now, I'm not saying the world is ending tomorrow. I'm saying the financial system is going through a transformation, and most people aren't prepared for it. The implications go even deeper. Think about geopolitics. If China controls most of the silver supply and production, and silver becomes critical for green energy and technology, who has the power? Right now, we need their solar panels, their batteries, their electronics, and they need our dollars. But what happens when they don't need dollars anymore? What happens when they have the real assets and we have the paper? The balance of power shifts. This is why this ratio matters so much. It's not just predicting a market crash, it's predicting a shift in global power, a transition from one system to another, from west to east, from paper to physical. And it's happening right now, in slow motion, while most people are distracted by daily news and social media. The question you have to ask yourself is, what side of this transition do you want to be on? Before we wrap up, there's one final thing you need to know. Here's the final piece that connects everything, the part that makes this whole story make sense. The ratio isn't just a number, it's a signal. It's the market's way of telling you what's real and what's fake. When the ratio is normal, around 16 to 1, it means the system is healthy, industry is running, money is stable, trade is working. When the ratio spikes above 80, it means the system is sick. People are scared. They're running from industrial metals into safe havens. The economy is breaking. Right now, at 85 to 1, the ratio is telling you two things at once. And this is the final shocking truth. Gold is saying, the currency is dying, trust is gone, protect yourself. Silver is saying, I'm waiting, I'm coiled, I'm about to move. They're both right, but they're telling different parts of the story. Gold moves first because it's the fear trade. When people get scared, they buy gold. That's already happening. Gold is at all-time highs. Silver moves second because it's both an industrial metal and money. It waits while everyone runs to gold. Then, when people realize silver is cheap compared to gold, and when industry realizes it's running out, silver explodes. We're in that waiting period right now. Gold has moved, silver hasn't yet. The gap is massive, the spring is coiled, and here's what most people miss. When silver finally moves, it doesn't move slowly, it moves violently. In 1979 to 80, it went up 8 times in months. In 2011, it doubled in a few months. Silver is known as the most volatile major commodity. When it breaks out, fortunes are made and lost in weeks. The ratio at 85-1 is telling you that breakout is coming. You're watching the spring get compressed. Every day that ratio stays high, more pressure builds, more industrial demand stacks up, more paper shorts pile on, more physical metal flows to the east, and then one day, something triggers it. Maybe a major shortage announcement, maybe a big fund starts buying physical, maybe China announces something about their reserves. Doesn't matter what the trigger is, the setup is what matters, and the setup is complete. Let me bring this full circle to where we started. The gold-silver ratio predicted the fall of Rome. It predicted the crime of 73, it predicted the Great Depression, it predicted 2008, it predicted the 2020 crisis. Every single time it spiked above 80, major change followed. Every time. It's not a perfect timer. It doesn't tell you the exact day, but it tells you that pressure is building, that the system is unstable, that change is coming. And right now, that ratio is flashing red at 85-1. The government can't fix this by printing more money. That just makes it worse. They can't fix it with new regulations. They can't talk their way out of it. The only thing that fixes a ratio this high is a reset. Either silver has to catch up to gold, or the whole system has to restructure. Based on history, both will probably happen. Silver will surge, and the monetary system will change. The question isn't if this happens, it's when, and what you do before it does. History is clear. When this ratio spikes, regular people who are prepared do well. People who aren't prepared suffer. In the 1930s, the people who held gold had it seized, but they got paid for it. The people who only had dollars in banks lost everything when banks failed. In 2008, people who owned physical assets did okay. People who only had stocks and paper assets got crushed. In 2020, people who owned hard assets made fortunes. People who only had cash watched its value evaporate through inflation. The pattern is always the same. When the ratio spikes, paper wealth transfers to physical wealth. Always. Right now, you're seeing the same signal, the same warning, the same setup. The only difference is the scale. The debt is bigger, the printing is faster, the shortage is more severe, the East is buying more aggressively. Everything is more extreme than before, which means the resolution will be more extreme too. I'm not here to tell you what to do with your money, but I am here to show you what the signal is saying. And that signal has been right for 2,000 years. Look at your savings. Look at what you're holding. Look at where your wealth is stored. Is it in paper that can be printed, or is it in physical things that exist in the real world? The ratio is screaming at 85-1. Gold is at all-time highs. Silver is still cheap. The industrial shortage is building. The East is buying everything. The spring is coiled as tight as it's ever been. In 5 years, when we look back at this moment, it's going to be obvious. The signal was there. The warning was clear. The ratio told us everything we needed to know. The only question is, were you paying attention? Were you one of the people who recognized the signal? Or were you part of the majority who ignored it until it was too late? History doesn't repeat, but it rhymes. And right now, it's rhyming loud and clear. The gold-silver ratio has spoken. The system is breaking. The transfer is happening. Now you know what everyone else is missing. Now you understand what the ratio really means. Now you see why this number matters more than the stock market, more than interest rates, more than anything else in finance. Because this ratio doesn't lie. It can't be manipulated forever. Physics and geology always win in the end. The last time silver hit this ratio, the global system broke, and it's about to happen again. The question is, will you be ready?